In the previous video, we discussed a few of the concepts of double entry bookkeeping, namely debits and credits and journals. A journal, recall, is a chronological listing of the financial transactions, each of which is entered twice, once from the perspective of a debit and once from the perspective of a credit. Now, let's transpose that information from a simple chronological listing and categorize it by account. Now, let's take that information that was recorded in the journal and construct our set of ledgers. A ledger recontextualizes the financial transactions recorded in the journal. Each account, whether it's cash, checking, accounts receivable, accounts payable, and all the rest, will have its own ledger. Here is our completed journal with transactions 1 through 8 from the previous video. In order to construct a set of ledgers, let's first identify the accounts that were affected by these transactions. The collectible asset account included physical items like old stamps, coins, and classic cars. Even old comic books, Hummel figurines, and Beanie Babies would qualify. These things are considered assets if we could determine their value in a secondary market. In our example in the previous video, it was a baseball card, maybe Babe Ruth or Hank Aaron. But we could determine its value by checking to see what a Babe Ruth or a Hank Aaron baseball card was currently selling for. If you'll recall, for bookkeeping purposes, we simply recorded its value as the price we paid for it. From time to time, you'd want to go back and adjust these values based upon changing market conditions. There's an accounting process for making such an adjustment while keeping the books balanced, but it's beyond the scope of this presentation on bookkeeping. If there was no secondary market for these items, you could not accurately assess its value. Although you may indeed be able to sell it, you probably couldn't guess what someone would ultimately pay for it, if anything. Therefore, you wouldn't consider an item for which there was no secondary market an asset. Paying money for such an item, such as an additional rubber band to add to your collection, would be considered an expense, not an expenditure on an asset. Cash is an asset for obvious reasons. In our example, there were 4 transactions that affected the cash account. Accounts receivable represents money that is owed to you. It's an asset if the debtor is legally, contractually obligated to pay. But if it's your brother-in-law that owes you money, I'd write this off as an expense. The car is an asset because there is an active and widespread used car market. Like the baseball card, we just recorded the value of the asset as the price we paid for it. But after a while, we'd have to go back and adjust its value as it became more used. Accounts payable is a liability. It's a category that includes all the debts we owe. The money you spent on groceries is considered an expense, unlike the purchase of the car or the baseball card, which were expenditures on assets. You spent money, but you don't have anything of value to show for your expense. Sure, you have groceries, which is a good thing, but you wouldn't be able to sell those groceries on a secondary market. They may have value in that they keep you alive, but they have no market value. So for our purposes here, they have no value. A checking account is an asset because it's almost like cash, but not as liquid. The term liquidity refers to the ease and cost of converting one asset into another. Cash is perfectly liquid. The seller has got to accept cash because it's legal tender. The seller does not have to accept your check, but usually they do because they're eager to sell their product. So checks are highly but not perfectly liquid. That car you purchased on January 3rd is an illiquid asset. It's usually a time-consuming pain to turn a car into cash or to trade it for some other item. And with all the transaction fees and bureaucratic red tape, it's expensive too. Here we have two transactions that affect the income accounts. Income from Acme, which were your wages, and interest income. Income, like an expense, is neither an asset nor a liability. A change in income does affect your equity. The more income you receive, the richer you get. An increase in equity is recorded as a credit. An offsetting debit could be recorded by the increase in cash or the value of your checking account. But we'd like to keep a separate account, one that is specific to the receipt of income. By doing so, we can construct an income statement, sometimes known as an income expense statement, so we can see how much richer or poorer we became over a given period of time. For that reason, we'll maintain an income account for now and eventually deal with adjusting the equity account later. That's what will happen when we close the books. Here's another expense account. In this case, interest expense. When you pay interest, you are paying for a service. So you spent money, but you have no asset to show for it. And so we consider interest an expense rather than an expenditure on an asset. When you spend money on clothes, it's a little bit like paying for a service, as in the case of interest expense. You did not receive an asset that you can sell. Clothes, unlike a service, are tangible items, and you may be able to get something for them if you try to sell them on eBay. But the price that somebody is willing to pay you for used clothes is unpredictable. In fact, my guess would be zero in most cases. So the purchase of clothing is an expense rather than an expenditure on an asset. Your credit card account keeps track of the money you owe to the bank as a result of using your credit card. When you use a credit card, you borrow money and incur a liability. There, we've identified all of the accounts that were affected by the transactions in the previous video. For the sake of simplicity and brevity, let's assume that the accounts identified in the journal are the only accounts there are, although even for small entities, whether a business or a family, there are usually many more. Let's also assume that as of January 1st, the only asset you have is $2,000 worth of cash and you have no liabilities. Your net worth, therefore, as of January 1st is $2,000. That's your equity, how rich you are. We'll divide this set of ledgers into four categories: assets, liabilities, income, and expenses. Now let's identify the category in which each of these accounts belong. Take a few moments to make sure you understand how each of these accounts was categorized before moving on. Pause the video if you need to. There are 5 asset accounts: collectible assets, cash, accounts receivable, the car, and your checking account. Before we group the liability, income, and expense accounts, let's set up the cash account to see how a ledger works. We'll use the cash account as the example because it has the most entries. The transactions recorded in the journal that affect the cash account will be transferred to the cash ledger. But before we do any transferring of data into the cash ledger, we need to carry over the debit balance in the cash ledger from the previous accounting period. As previously indicated, you are starting out this accounting period with $2,000 in cash, but with no other assets or liabilities. The net ending balance from the previous period of this and all other asset, liability, and equity accounts will roll over from one period to the next. The ending balances of your income and expense ledgers will not carry over, as you will see when we close the books. We'll use that star there to indicate that it represents a carryover. Because the equation of net worth was perfectly balanced at the end of the previous accounting period, the $2,000 debit carried over in the cash ledger is offset with a $2,000 credit carried over in the equity ledger. As you know, an increase in an asset is a debit, and an increase in either a liability or equity is a credit. Therefore, a positive closing balance from the previous period in the cash ledger is indicated by a net debit balance, and a positive closing balance from the previous period in the equity ledger is indicated by a net credit balance. The equity ledger provides the most important information of all of the accounts because it tells you how rich or poor you are. The equity ledger doesn't have any transactions transferred directly from the journal, as do the asset or liability ledgers. The equity ledger will not be affected until we close the books. So here's our starting point for the accounting period beginning January 1st. We have $2,000 in cash, no other assets, and no liabilities. Therefore, our net worth is $2,000. Now we're ready to begin transferring data from the journal to the cash ledger. Each of these transactions from the journal affecting the cash account is transferred to the cash ledger. Pause the video for a moment to make sure you understand where each of these entries in the cash ledger come from. At the end of the accounting period, these entries are then totaled and summarized. As you can see, the cash ledger has a net debit balance of $950. That was computed by subtracting the credits from the debits. All of the other asset ledgers work in the same way. And here they are. Notice that there are no carryovers from the previous accounting period. At this point, you might pause the video to make sure you understand where each of these numbers come from. Now let's construct the liability ledgers. As you can see, there are two liability accounts. And here are the liability ledgers, accounts payable and credit card. As you know, your credit card account is actually an accounts payable. But let's keep the credit card separated from our other payable accounts because that will make the analysis of our finances easier once we get to it. Here are those numbers being transferred from the journal to the ledgers. Again, take a few moments to make sure you understand where these numbers come from. Pause the video if you need to. Now we're ready for the two income accounts. Again, make sure you understand where those numbers come from. Recall that income is entered as a credit. That's because when you receive income, either your cash account or your checking account, both assets, go up. And when an asset goes up, that's a debit. Income is entered as a credit to offset those debits. There are three expense accounts: groceries, clothing, and interest. In contrast to income, expenses are treated as debits. That's because when you pay money to buy something, either your cash account or your checking account, both of which are assets, goes down, which of course is considered a credit. Or if you were to use your credit card, your liabilities would go up, and that's also a credit. But with an expense, you're not buying an asset, which would be the offsetting debit. So, to offset the credit, we must consider an expense as a debit. Now we are finished transferring, totaling, and summarizing the information from the journal to a form that is more useful. So let's first use these ledgers to check for mistakes. We can do so by constructing a trial balance. A trial balance is a document that sums all the net debit and credit balances from all the ledgers to make sure that the debits equal the credits. If the debits and the credits aren't equal, we've made a mistake. We've got to go back and find it. Here's what a trial balance looks like. We'll transfer the net debits and the net credits from all of the ledgers into this document. And at the end, we hope that the sums of the two will be equal. Let's start with the equity ledger. The equity ledger is unique and very important. Unique because no information was transferred directly from the journal into the equity ledger. Important because it tells you how rich you are. At the beginning of this accounting period, your net worth was $2,000. That was carried over from the end of the previous accounting period. This value will change, however, and accurately reflect your current net worth after we've closed the books. Here, we've transferred the $2,000 net credit balance from the equity ledger into the trial balance. Here's the net debit in the cash ledger being transferred to the trial balance. Now we'll transfer all of the net debit balances from the asset ledgers into the trial balance, starting with collectibles, accounts receivables, the car, and the checking account. Now we'll enter the net credit balances from the liabilities account, starting with accounts payable and the credit card. Now we'll enter the net credit balances from the income ledgers, starting with the income from Acme, your wages, and your interest income. Now let's enter the net debit balances from the expense ledgers, starting with groceries, then the clothing expense, and finally interest expense. There, we've totaled the two columns. Thankfully, the trial balance shows that the sum of the debits and the credits are equal. We don't have to go back and find any mistakes. So now we can start doing some analysis. Let's start with the income statement, also called the income expense statement. An income statement is a document that is divided horizontally. In the top section, we'll list the sources and amounts of income we receive during the accounting period. An accounting period for most entities is usually 1 month. In the bottom section, we'll list our expenses, how we used our income, and the amount that was spent to purchase things other than assets. As a reminder, recall that expenditures on assets will show up in ledgers as credits to cash, checking, or credit card balance, and debits to the asset account. Spending on non-assets, such as services, charitable donations, or other things that are not bought and sold in secondary markets and hypothetically have no market value, are simply called expenses rather than expenditures. As with expenditures, these transactions are recorded in the ledgers as credits to cash, checking, or credit card accounts, and to offset these credits, expenses are recorded as debits in the expense ledgers. So let's begin listing our sources of income. The income from Acme and your interest income totaled $1,050. The grocery, clothing, and interest expenses totaled $380. The net gain for the period was $670. But how did this net gain of $670 affect your wealth? We'll need the balance sheet to show us how wealthy we are at this very moment. But before we start working on the balance sheet, we'll need to close the books. Closing the books requires us to zero out the income and expense ledgers at the end of an accounting period by making closing entries, which are then transferred to the equity ledger. Asset and liability accounts do not need to be zeroed out at the end of an accounting period. The ending balances in these accounts can be carried over to the next accounting period, as we saw earlier with the cash account. Let's start with the two income accounts. We can zero out the income from Acme account by making a closing entry. By entering a debit of $1,000, we bring the net balance to zero. But this artificial debit will require us to enter an offsetting credit in the equity account. There's the offsetting credit in the equity account, bringing the net credit balance so far to $3,000. Now we'll zero out the interest income account by making a closing entry. By entering a debit of $50, again, we bring the net balance to zero. As in the previous case, this artificial debit will require us to enter an offsetting credit of $50 in the equity account, now bringing the net credit balance to $3,050. Because expenses are entered as debits, the closing entries will have to be credits. As you can see, these credits have already been entered, bringing the net balance in each ledger to zero. These $380 worth of credits must now be offset with $380 worth of debits in the equity ledger. This, our final closing entry, will bring the net credit balance in the equity ledger to $2,670. All income and expense accounts have been zeroed out. So now we can move on to the balance sheet. To help understand the balance sheet, first recall this relationship. Unlike the income statement, which was divided horizontally, the balance sheet is divided vertically. In the left-hand section, just like in the equation of net worth, we list the value of the assets, and then we add them up. Then we do the same thing for the other side of the balance sheet. And as the equation indicates, the sum of the assets must equal the sum of the liabilities plus equity. If the bottom line on each of these two sides of the balance sheet are equal, we know we haven't made a mistake. So let's actually add some numbers. We will populate the asset side of the balance sheet with the net debit balances of our asset ledgers. The net debit balance in our cash ledger at the end of the accounting period was $950. In the car ledger, it was $5,000, $100 in collectibles, $800 in checking, and $0 in accounts receivable. The total value of our assets was then $6,850. Now, we'll record all the credit balances from our liabilities ledgers. The net credit balance in the accounts payable ledger was $4,000. And in the credit card ledger, it was $180. Summing those two values, we see that our total liabilities add up to $4,180. So now let's transfer the credit balance of the equity ledger over to the balance sheet. After we closed the books, the credit balance in our equity ledger was $2,670. After adding the total of the liabilities to the net worth, we see that the value of the assets is equal to the sum of the liabilities and equity. The balance sheet is balanced. All of our financial information is now organized in a way that will allow us to perform some analysis to assess our current financial situation. Now let's mention a few accounting values and ratios that we will need to analyze our finances. To assess our current financial situation, we'll need numbers from the income statement and the balance sheet. For a more in-depth explanation, be sure to read the lecture notes in Module 3 entitled Assessing Your Financial Condition. Probably the most important number in your entire set of accounting records is your net worth. This value tells you how rich you are. The next most important would be your gain or loss, which you'd find at the bottom of your income statement. This tells you how much richer or poorer you became in the previous accounting period, assuming, of course, that the value of all your assets remained the same. The liquidity ratio divides your liquid assets by your monthly expenses. Liquidity, recall, refers to the ease with which one asset can be converted into another asset. Government-issued cash, for example, is perfectly liquid because it's legal tender. Checking and savings accounts are highly, but not perfectly liquid. Real estate is a highly illiquid asset. It takes a lot of time, a lot of stress, and a lot of money to sell a house or a piece of land. You can learn more about the term liquidity by reading the lecture notes in Module 3 entitled Liquidity versus Solvency. Few things in life are certain, but one of them is that you can expect the unexpected. Therefore, you'll want to keep some of your assets in a highly liquid form, such as cash, checking, and other cash equivalents, so that you won't have to go through the hassle and expense of trying to sell illiquid assets in order to cover those unexpected expenses. The problem is, as you'll see in Module 5, the more liquid the investment asset, the lower will be the rate of return. So the trick is to find the right balance of liquid and illiquid assets so you can get a high rate of return on your investments while still being able to cover unexpected expenses. Most financial analysts recommend a ratio of 6 months. This information would come from both the balance sheet and the income statement. So you can use these accounting documents along with that 6-month guideline to determine if you're too liquid or not liquid enough. The cash flow ratio tells you how much of your monthly income is committed to your contractual expenses, that is, your bills, each month. Both of these values will come from the income statement. This ratio indicates how large a monthly cushion you'll have for discretionary spending, unexpected expenses, or putting money away for some financial goal. You'll obviously want the highest ratio possible. If you're cutting it too close, you'll want to be sure that you have adequate liquid assets. You might also want to adjust your expenses or your income. The debt-to-asset ratio divides your total liabilities by your total assets. When you first start supporting yourself and your dependents, this ratio will probably be quite high. However, over time, you'll want to arrange your finances so that this ratio continually falls. As long as this ratio falls, you're gaining ground, financially speaking. Remember, assets are items that have value because they can be sold, and they contribute to your net worth. Expenses do not. The debt-to-income ratio is another ratio that will tell you if, over time, you're gaining ground or losing ground. In both this and the debt-to-asset ratio, you'll want to exclude mortgage payments on your house, because that's really an investment. This one's pretty self-explanatory. We'll dig a little deeper into this ratio when we get to Module 7 on major purchases. But there are a number of guidelines that you can use to determine if this ratio indicates that you're spending too much of your income on housing, or if you can afford to go larger, if you choose to. Again, it's beyond the scope of this presentation to dig too deeply into these very useful financial ratios. They were mentioned here just to remind you that all of this information will come from the income statement and/or the balance sheet. You'll learn more about these ratios in the lecture notes in Module 3 entitled Assessing Your Current Financial Situation. In this presentation, we developed the idea of an income statement, which tells us how much richer or poorer we became over some period of time, the balance sheet, which gives us a snapshot of how rich we are at this current moment in time. Next, we will want to consider the budget. This will give us a planning tool for organizing, analyzing, and managing our finances and meeting our financial objectives. As you can see, it looks like the income statement. But rather than comparing income that has been received and expenses that have been incurred, it compares income that you expect to receive at some future point in time and expenses that you expect to incur. And while the income statement can be constructed using either the cash basis of accounting or the accrual basis of accounting, you'll definitely want to use the cash basis of accounting for constructing a budget. That way, it also becomes a cash flow tool for monitoring where our money will come from, where it will go, and what financial goals we can achieve, and when. We'll use this knowledge about bookkeeping to construct a budget.